So guys, happy new month and happy Halloween. I should have put on my costume to make this video. But well, I don't know if you feel this is an African costume, not the Halloween one. Oh god. Are you loving my voice? Because I don't know how you're going to find my voice. Welcome to today's reading. And honestly, I lost my voice some days ago, and I'm still recovering. I don't know if you can hear it in my voice, if you can feel it, if you can hear it, if you can feel it. But then you know, in as much as I would have loved to wait to when I am able to do this, but then I just miss doing this, and I want to do this, and nothing is gonna stop us from doing what we love to do. How did I sound? Okay, so now you remember the last reading we did, right? Where we say give yourself room for error. Give yourself room for error. And we also said something like, okay, part of what we learned was you have to survive to succeed. Okay, let me say part of my own take home. You have to survive to succeed. Give yourself room for error. No risk that can wipe you out is worth taking. Like if you want to take a risk, it's not about being insecure or not having the confidence in your ability. Just make sure there is something you can fall back on if your plan does not go accordingly, if your plan does not go the way you want it to go. And then, what is the solution to what ifs in finance? What is the solution to what ifs in finance? There are so many what ifs in finance. So, what is the solution to it? Room for error, giving yourself room for error. That was all about our last week reading. And this week, we'll be moving into nothing is free. Mhm. Nothing is free. That last week we also read You Will Change. Yeah, so today's reading will be chapter 15. Nothing is free. Everything has a price, but not all prices appear on labels. Not all prices appear on labels, and not all prices you pay to the cashier. So everything has a price, and the key to a lot of things with money is just figuring out what price is and being willing to pay it. The problem is that the price of a lot of things is not obvious until you've experienced them firsthand when the bill is overdue. General Electric was the largest company in the world in 2004, worth a third of $1 trillion. It had either been first or second each year for the previous decade. Capitalism shining example of corporate aristocracy. Then everything fell to pieces. The 2008 financial crisis sent GE's financing division, which supplied more than half of the company's profits, into chaos. It was eventually sold for crap. Subsequent bets in oil and energy were disasters, resulting in billions in write-offs. GE stocks fell from $40 in 2007 to $7 by 2018. Blame placed on CEO Jeff Immelt, who ran the company since 2001, was immediate and harsh. He was criticized for his leadership, his acquisitions, cutting the dividend, laying off workers, and of course, the plunging stock price. Rightly so. Those rewarded with dynastic wealth when times are good hold the burden of responsibility when the tide goes out. He stepped down in 2007. But Emmett said something insightful on his way out. Listen to what he said. He said, responding to critics who said his actions were wrong and what he should have done was obvious, Emmett told his successor, every job looks easy when you are not the one doing it. That is true. Every job looks easy when you're not the one doing it because the challenges faced by someone in the arena are often invisible to those in the crowd. Dealing with the conflicting demands of sprawling bloat, short-term investors, regulators, unions, and entrenched bureaucracy is not only hard to do, but it is hard to even recognize the severity of the problems until you are the one dealing with them. Image successor who lasted 14 months learned this as well. 14 months. Most things are harder in practice than they are in theory. It's easy to say, but it's not easy to do. Sometimes this is because we are overconfident. More often, it is because we are good at identifying what the price of success is, which prevents us from being able to pay it. The S&P 500 increased 119-fold in the 50 years ending 2018. All you had to do was sit back and let your money compound. But of course, successful investing looks easy when you are not the one doing it. Hold stocks for the long run, you will hear it is good advice. But do you know how hard it is to maintain a long-term outlook when stocks are collapsing? Like everything else worthwhile, successful investing demands a price, but its currency is not dollars and cents. It is volatility, fear, doubt, uncertainty, and regret, all of which are easy to overlook until you are dealing with them in real time. The inability to recognize that investing as a price can tempt us to try to get something for nothing, which, like shoplifting, rarely ends well. Say you want a new car, it costs $30,000. You have three options. One, pay $30,000 for it. Two, find a cheaper used one. Three, steal it. In this case, 99% of people know how to avoid the third option because the consequences of stealing a car outweigh the upside. But say you earn an 11% annual return over the next 30 years so you can retire in peace. Does this reward come free? Of course not. The world is never that nice. There is a price tag, a bill that must be paid. In this case, it's a never-ending taunt from the market, which gives big returns and takes them away just as fast. Including dividends, the Dow Jones Industrial Average returned about 11% per year from 1950 to 2019, which is great. But the price of success during the period was dreadfully high. Now, here is the important part, radical. You have a few options. You can pay this price, accepting volatility and upheaval, or you can find an asset with less uncertainty and a lower payoff, the equivalent of a used car. Or you can attempt the equivalent of a grand theft auto. Try to get the return while avoiding the volatility that comes along with it. Many people in investing choose the third option like a captive, though well-meaning and law-abiding, they form tricks and strategies to get the return without paying the price. They trade in and out. They attempt to sell before the next recession and buy before the next boom. Most investors with even a little experience know that volatility is real and common. Many then take what seems like the next logical step, which is trying to avoid it. But the money gods do not look highly upon those who seek a reward without paying the price. Some captives will get away with it. Many more will be caught and punished. Same thing with investing. Morningstar wants to look at the performance of tactical mutual funds whose strategy is to switch between stocks and bonds at opportune times, capturing market returns with lower downside risks. They want the returns without paying the price. The study focused on the mid-2010 through late 2011 period, when US stock market went wild on fears of a new recession and the S&P 500 declined more than 20%. This is the exact kind of environment tactical funds are supposed to work in. It was their moment to shine. There were, by Morningstar's count, 112 tactical mutual funds during this period. Only 9 had better risk-adjusted returns than a simple 60-40 stock bond fund. Less than a quarter of the tactical funds had smaller maximum drawdowns than the Leave It Alone index. Morningstar wrote, with a few exceptions, gained less, were more volatile, or were subject to just as much downside risks as the hands-off fund. Individual investors fall for this when making their own investments. The average equity fund investor underperformed the fund they invested in 0.5% per year. According to Morningstar, the result of buying and selling when they should have bought and held. The irony is that by trying to avoid the price, investors end up paying double. Back to GE, one of its many faults stems from an era under former CEO Jack Welch. Welch became famous for ensuring quarterly earnings per share beat Wall Street estimates. He was the grandmaster. If Wall Street analysts expected 0.25 dollars per share, Jack would deliver $0.26 no matter the state of business or the economy. He had did that by massaging the numbers. That description is charitable, often pulling gains from future quarters into the current quarter to make the obedient members salute their master. Forbes reported one of dozens of examples. The General Electric, for 2 years in a row, sold locomotives to unnamed financial partners instead of end users in transactions that left most of the risks of ownership with GE. Welsh never denied this game. He wrote in his book Straight from the Gut, the response of our business leaders to the crisis was typical of the GE culture. Even though the books had closed on the quarter, many immediately offered to pitch in to cover the earning gap. Some said they could find an extra $10 million, $20 million, and even $30 million from their business to offset the surprise. The result was that under Walsh's leadership, stockholders didn't have to pay the price. They got consistency and predictability, a stock that surged year after year without the surprises of uncertainty. Then the bill came due, like it always does. GE shareholders have suffered through a decade of mammoth losses that were previously shielded by accounting maneuvers. The penny gains of Walsh's era became dime losses today. The strangest example of this comes from failed mortgage giants Freddie Mac and Fannie Mae, which in the early 2000s were caught underreporting current earnings by billions of dollars with the intention of spreading those gains out over future periods to give investors the illusion of smoothness and predictability, the illusion of not having to pay a price. The question is, why do so many people who are willing to pay the price of cars, houses, food, and vacations try so hard to avoid paying the price of good investment returns? The answer is simple. The price of investing success is not immediately obvious. It is not a price tag you can see, so when the bill comes due, it doesn't feel like a fee for getting something good. It feels like a fine for doing something wrong. And while people are generally fine with paying fees, fines are supposed to be avoided. You are supposed to make decisions that preempt and avoid fines. Traffic fines and IRS fines means you did something wrong and deserve to be punished. The natural response for anyone who watches their wealth decline and views that drop as a fine is to avoid future fines. It sounds trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. Few investors have the disposition to say, I am actually fine if I lose 20% of my money. This is doubly true for new investors who have never experienced a 20% decline. But if you view volatility as a fee, things look different. Disneyland tickets cost $100, but you get an awesome day with your kids you will never forget. Last year, more than 18 million people thought that fee was worth paying. Few felt the $100 was a punishment or a fine. The worthwhile trade-off of fees is obvious when it is clear you are paying one. Same with investing, where volatility is almost always a fee, not a fine. Market returns are never free and never will be. They demand you pay a price like any other product. You are not forced to pay this fee, just like you're not forced to go to Disneyland. You can go to a local county fair where tickets might be $10 or stay home for free. You might still have a good time, but you will usually get what you pay for. Same with markets. The volatility uncertainty fee, that's the price of returns, is the cost of admission to get returns greater than low fee packs like cash and bonds. The trick is convincing yourself that the market fee is worth it, not just that's the only way to properly deal with volatility and uncertainty. Not just putting up with it, but realizing that it is an admission fee worth paying. There is no guarantee that it will be. Sometimes it trains at Disneyland, but if you view the admission fee as a fine, you will never enjoy the magic. So the take home here is find a price, then pay it. Find a price, then pay it. Nothing is free. Everything has a price. It's just that not all things comes with a price label. So we're moving on to the next chapter, which is you and me, chapter 16. Beware. Beware taking financial cues from people playing a different game than you are. Beware taking a financial cue from people playing a different game than you are. Now, reading on chapter 16. The next chapter I'll be reading is You and Me. So now, reading on. The implosion of the dot-com bubble in the early 2000s reduced household wealth by $6.2 trillion. The end of the housing bubble cut away more than $8 trillion. It is hard to overstate how socially devastating financial bubbles can be. They ruin lives. Why did these things happen? Why do they keep happening? Why can't we learn our lesson? The common answer here is that people are greedy, and greed is an indelible feature of human nature. That may be true, and it's a good enough answer for most. But remember, chapter 1, no one is crazy. That was our chapter 1. People make financial decisions they regret, and they often do so with scarce information and without logic. But the decisions made sense to them when they were made. Blaming bubbles on greed and stopping there misses important lessons about how and why people rationalize what in hindsight look like greedy decisions. Part of why bubbles are hard to learn from is that they are not like cancer, where a biopsy gives us clear warning and diagnosis. They are closer to the rise and fall of a political party, where the outcome is known in hindsight, but the cause and blame are never agreed upon. Competition for investment returns is fierce, and someone has to own every asset at every point in time. That means the mere idea of bubbles will always be controversial because no one wants to think they own an overvalued asset. We are more likely to point cynical fingers than to learn lessons. I don't think we'll ever be able to fully explain why bubbles occur. It's like asking why wars occurs. There are almost always several reasons, many of them conflicting, all of them controversial. It's too complicated a subject for simple answers. But let me propose one reason they happen that both goes overlooked and applies to you personally. Investors often innocently take cues from other investors who are playing a different game than they are. An idea exists in finance that seems innocent but has done incalculable damage. It's the notion that assets have one rational price in a world where investors have different goals and time horizons. Ask yourself, how much should you pay for Google stock today? The answer depends on who you are. Do you have a 30-year time horizon? Then the smart price to pay involves a sober analysis of Google's discounted cash flows over the next 30 years. Are you looking to cash out within 10 years? Then the price to pay can be figured out by an analysis of the tech industry's potential over the next decade and whether Google management can execute on its vision. Are you looking to sell within a year? Then pay attention to Google's current product sales cycles and whether we'll have a bear market. Are you a day trader? Then the smart price to pay is who cares? Because you are just trying to squeeze a few bucks out of whatever happens between now and lunchtime, which can be accomplished by any price, which can be accomplished at any price. When investors have different goals and time horizons, and they do in every asset class, prices that look ridiculous to one person can make sense to the other because the factors those investors pay attention to are different. Take the dot-com bubble in 1990s. People can look at Yahoo stock in 1999 and say that was crazy. A zillion times revenue, the valuation made no sense. But many investors who owned Yahoo stock in 1999 had time horizon so short that it made sense to them to pay a ridiculous price. A day trader could accomplish what they need, whether Yahoo was at a $5 share or $500 a share, as long as it moved in the right direction that day. And it did for years. And an iron rule of finance is that money chases returns to the greatest extent that it can. If an asset has momentum, it's been moving consistently for a period of time. It's not crazy for a group of short-term traders to assume it will keep moving up, not indefinitely, just for the short period of time they need it to. Momentum attracts short-term trader in a reasonable way. Then it's off to the races. Bubbles form when the momentum of short-term returns attracts long enough money that the makeup of investors shifts from mostly long-term to mostly short-term. That process feeds on itself. As traders push up short-term returns, they attract even more traders. Before long, and it often doesn't take long, the dominant market price setters with the most authority are those with shorter time horizons. Bubbles aren't so much about valuations rising, that's just a symptom of something else. It is common to say the dot-com bubble was a time of irrational optimism about the future, but one of the most common headlines of that era was announcing record trading volume, which is what happens when investors are buying and selling in a single day. Investors, particularly the ones setting price, we are not thinking about the next 20 years, no. The average mutual fund had 120% annual turnover in 1999, meaning they were at most thinking about the next 8 months. So were the individual investors who bought those mutual funds. Maggie Maher wrote in her book Bull, by the mid-90s, the press has replaced annual scorecards with reports that appeared every 3 months. The change squared investors to chase performance, rushing to buy the funds at the top of the chart just when they were most expensive. This was the era of day trading, short-term options contracts, and up-to-the-minute market commentary. It's not the kind of thing you'd associate with long-term views. The same thing happened during the housing bubble of the mid 2000s. It's hard to justify paying $700,000 for a two-bedroom Florida tract home to raise your family in for the next 10 years. But it makes perfect sense if you plan on flipping the home in a few months into a market with rising prices to make a quick profit, which is exactly what many people were doing during the bubble. Data from Atom, a company that tracks real estate transactions, shows the number of houses in America that sold more than once in a 12-month period. They were flipped, rose fivefold during the bubble from 20,000 in the first quarter of 2000 to over 100,000 in the first quarter of 2004. Flipping plunged after the bubble to less than 40,000 per quarter, where it is roughly remained since. Do you think these flippers cared about long-term price to rent ratios? No, or whether the prices they paid were backed up by long-term income growth? Of course not. Those numbers weren't relevant to the growth. The only thing that mattered to flippers was that the price of the home would be more next month than it was this month. And for many years, it was. You can say a lot about these investors. You can call them speculators. You can call them irresponsible. You can shake your head at their willingness to take huge risks, but I don't think you can call them irrational. The formation of bubbles isn't so much about people irrationally participating in long term investing, they are about people somewhat rationally moving towards short term trading to capture momentum that has been feeding on itself. What do you expect people to do when momentum creates a big short term return potential? Sit and watch patiently? Never. That's not how the world works. Profits will always be chased. And short term traders operate in an area where the rules governing long term investing, particularly around valuation, are ignored because they are irrelevant to the game being played. That's where things get interesting and where the problems begin. Bubbles do their damage when long-term investors playing one game start taking their cues from those short-term traders playing another. Cisco stock rose 300% in 1999 to $60 per share. At that price, the company was valued at $600 billion, which is insane. Few actually thought it was worth that much. The day traders were just having their fun. Economist Burton Michael once pointed out that Cisco's implied growth rate at, at that valuation meant it would become larger than the entire US economy within 20 years. But if you were a long-time investor in 1999, $60 was the only price available to buy, and many people were buying it at that price. So you may have looked around and said to yourself, wow, maybe those other investors know something I don't. Maybe you went along with it, you even felt smart about it. What you don't realize is that the traders who were setting the marginal price of the stock were playing a different game than you were. $60 a share was a reasonable price for the traders because they planned on selling the stock before the end of the day when its price would probably be higher. But $60 was a disaster in the making for you because you plan on holding the shares for the long run. Then, these two investors rarely even know that each other exists, but they are on the same field running toward each other. When their paths blindly collide, someone gets hurt. Many finance and investment decisions are rooted in watching what other people do and either copying them or betting against them. But when you don't know why someone behaves like they do, you won't know how long they will continue acting that way, what will make them change their mind, or whether they will ever learn their lessons. When a commentator on CNBC says you should buy this stock, keep in mind that they do not know who you are. Are you a teenager trading for fun, an elderly widow on a limited budget, a hedge fund manager trying to shore up your books before the quarter ends? Are we supposed to think those three people have the same priorities and that whatever level a particular stock is trading is right for all of them? It is crazy. It is hard to grasp that other investors have different goals than we do because an anchor of psychology is not realizing that rational people can see the world through a different lens than your own. Rising prices persuade all investors in ways the best marketers envy. They are a drug that can turn value conscious investors into dewy eyed optimists, detached from their own reality by the actions of someone playing a different game than they are. Being swayed by people playing a different game can also throw you off how you are supposed to spend your money. So much consumer spending, particularly in developed countries, is socially driven, subtly influenced by people you admire, and done because you want people to admire you. But while we can see how much money other people spend on cars, homes, clothes, and vacations, we don't get to see their goals, worries, and aspirations. A young lawyer aiming to be a partner at a prestigious law firm might need to maintain an appearance that he, a writer who can work in sweatpants, have no need for. But when his purchases set my own expectations, I am wandering down a path of potential disappointment because I am spending the money without the career boost he is getting. We might not even have different styles. We are just playing a different game. It took me years to figure this out. The takeaway here is that few things matters more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. The main thing I can recommend is going out of your way to identify what game you are playing. It's surprising how few of us do. We call everyone investing money investors. Like they are basketball players all playing the same game with the same rules. When you realize how wrong that notion is, you see how vital it is to simply identify what game you are playing, how I invest my own money is detailed in chapter 20. But years ago, I wrote out, I am a passive investor optimistic in the world's ability to generate real economic growth, and I am confident that over the next 30 years, that growth will accrue to my investment. This might seem quaint, but once you write that mission statement down, you realize everything that is unrelated to it, what the market did this year, or whether we'll have a recession next year is part of a game I am not playing. So I don't pay attention to it and I am in no danger of being persuaded by it. Now, let's talk about pessimism. The seduction of pessimism. Optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. That is chapter 17, the seduction of pessimism. For reasons I have never understood, people like to hear that the world is going to hell. That's by historian Deirdre McCloskey. Should we stop our reading here or should we move on? I feel like reading on. But then, see you at our next reading. Take care of yourself. Be good. Bye.